Everyone dreams of living an uncommon life, and the best asset you have to achieve your dreams is you. Welcome to the Uncommon Wealth Podcast. We're going to introduce you to people who are living uncommonly. We're also going to give you some tools and strategies for building wealth and for pursuing an uncommon path that is uniquely right for you.
Hello and welcome everybody to another episode of the Uncommon Wealth Podcast. You know, it's hard when you change your name.
It's hard when you change your name.
Thanks for tuning in. We're grateful that you're here. We like that we used the whole podcast Uncommon Wealth because that's what we do. We'll give you ideas to be able to look at your money a little differently, to walk this path that you're uniquely gifted to do, financial advisors, and then we have a guest on the show. And before we get into the bio, don't you start that yet, Brian. We had a person that did business evaluations on the show last season with the Uncommon Life Project, if you remember that. They were from Principal Financial Group, and we were kind of jockeying, had a great podcast. And at the end of it, I asked them, okay, like this was off air, how about you do a business valuation for us at Uncommon Wealth? She's like, oh, I'm sorry, we don't do that for financial advisors. And I was like, okay. And then Brian's like, what about this? And she's like, yeah, we don't do that for either. And so it was a small quadrant, I guess, that she was actually wanting to do, which really frustrated us. So Brian calls it a small sliver. We actually have a person that actually does a huge sliver, if not everything, for business evaluation. He's on the show now. His name's Matt. Brian, give us a bio, and then we'll go into it.
Let's do it. We've got the one and only Matt Fett with us today from BCC Advisers. Matt specializes in providing business valuations, go figure, for closely held companies for a multitude of purposes. We will unpack the multitude of purposes because that's a general statement, and we want to go deep today with Matt. Welcome to the show.
Thanks, guys. Good to be here.
That was an amazing voice, Brian.
I feel like I'm getting more and more radio Brian versus normal Brian. Sorry.
All right, Matt, how did you get into business valuations? And one, I will say, it is super valuable what you do. Obviously, you know that. But as business owners, sometimes we can just be putting our nose to the grindstone for so long, and we don't feel like there is really anything valuable there, which there actually really is. And at Uncommon Wealth Partners, we try to help people understand what that value is and how that helps them in retirement, because it does. It's an asset, and you get to help them quantify it. So how did you get into it?
Yeah, absolutely. So I graduated from Iowa State University in 2008. December of 2008. Yeah, it was a cyclone.
Oh, man.
Brian knows.
I quit my job in December of 2008, so I'm already tracking with you.
Yeah. So a couple months after Lehman Brothers goes bankrupt, I graduated with a finance degree. Nobody is hiring for finance, but ended up at BCC Advisers. They were looking for someone straight out of college. And I've been there ever since. So 13 years, same company, kind of the anti-millennial stance. But yeah, it's been a great career. 13 years. I became partner, I think 3 or 4 years ago.
Nice, so, man.
Yeah, it's been great.
I didn't know that.
Yeah.
Oh, I've got a lot of questions.
No, that's great. Happy
Okay, how in the world, why do you think they would just went after somebody straight out of college? Like, that's a different approach.
Yeah, absolutely. And so, a good employee in our industry has a background in either accounting or finance, but they don't know anything about business valuation. So you don't want to hire somebody from a CPA firm that has 4 years of experience and wants a salary of a CPA with 4 years of experience. So we have found that hiring people out of college, training them from the get-go in business valuation has kind of been the best approach for us.
I love it.
Yeah.
Okay. All right. So they reach out to you and you're like, I've never thought about business evaluations, but it seems like right in my wheelhouse.
Well, my least favorite class in college was doing valuations for businesses. But it was more that I just didn't understand it as well as I do now. So it kind of flipped my stance on that. It's kind of
things change when they start paying you. Then it's like, maybe I like this.
Yeah. And working with the business owners changes a lot too, because you can actually see the impact of your work.
Dude, that's a great point. When we feel like we were dealing with, like, it's just emotional. I'll just say that. It's emotional. Especially when they're at the end of, like, their career and they start thinking about the next generation passing it on. Man, it's scary. It's emotional. And, like, Brian, I love how you say this. You say, it's kind of like a child. Like, you raise it up. It starts to walk. You remember the first time it rode its bike. There's a lot of things and memories. Tell me how working with business owners and at kind of the end of the stage where they're evaluating it, how emotional it can be, and then maybe some tools to not make it emotional.
Yeah, absolutely. Yeah, that's a great point. The biggest hurdle for a lot of business owners is just, what am I going to do after this?
Right.
And so, if they sell the business, typically the buyer wants you to stay on for a couple of years. So there's kind of an off ramp there. The last couple of months, a lot of the business owners have worried, can I afford to sell?
Right.
Because of,
Yes.
the downturn in the economy. So that's kind of been a new thing to help people through as well. But everybody's different. Everyone has different hangups. Sometimes it's the control issues. Sometimes it's the financial issues. But we try to help them understand that there is life after the business, and set it up the best to survive after you let it go, essentially.
Okay, so you got horror stories. Give me a horror story. We were all thinking
Let's
it.
just get right into it.
Yeah, come on, Matt.
Boy, what kind of horror story? Are you talking bad clients?
No, everybody's people, and people are people.
Yeah.
But like where a situation went south quick and you just never could get it back, and it's just like hot mess express without throwing your whole company under the bus, because it's emotional. So I know there's stories, and here's what I would say as being a business owner. You always value your business more than what it's really valued as.
Yes.
So maybe I'm asking about that.
A business is worth what someone's willing to pay for it.
Yeah. And so there's a difference between price and value.
Right.
And sometimes having that
There you go.
discrepancy, people can't put those together. Recently I've had more than one client. I give them the value of their business, and they want me to add the value of the assets to the value of the business. And they just don't understand that that's not exactly how it works. If you sell the assets, you can't have a business anymore because you can't generate the cash flow that those assets have.
Right.
And so that's kind of been a hurdle for me recently that I've had 3 or 4 clients struggling to understand.
Yeah, it's like in life insurance. It's like, I want the cash value and the death benefit. Well, you're getting the death benefit, and it's way more than you ever put into it. So it's kind of the deal. That's how it works.
Tax-free.
Same thing.
Yeah.
Yeah, it's stuff like that. Just helping people understand that, and then once you get past that step, then they can kind of fully understand how the business works. If you're a buyer, what are you buying? You want to buy the future cash flows of the business. And so once they kind of understand that, then the conversations go a lot better.
So we kind of talk about it, we're in the financial services business, and by federal law, you have to get a quarterly statement. There's no quarterly statement per se that comes in the mail and you can show your wife like, oh, look, honey, look at the value of our business. Yeah. And it's hard. Like, we've been doing this now almost a decade. No, it's been a decade. And we don't get that like statement in the mail, from Principal, since we were talking about Principal. Yeah. Like, oh, there's that 401k statement on the value of our business. It doesn't work like that. So when do you kind of start suggesting as a business matures to like, hey, it might be time to get a business valuation just to check in? And
Great question.
Yeah, it is a great question. And generally, in my experience, businesses don't get a valuation until they have to. I like to say that we help businesses in transition. Any kind of transition you go through, that's typically where our firm comes and helps. Occasionally, we get people that just want to know, and we have a smaller, scaled down analysis that we do for those clients. Kind of just give a range of values, do some calculation. That kind of helps them
plan.
Plan, exactly. And helps you guys plan too.
Yeah.
If they kind of have a better understanding of their business. We've had a lot of business owners that they've had their head down working in their business their whole lives, and they come to us, they don't even have a guess as to what it's worth. And sometimes it turns out well for them, but a lot of times it doesn't, because they're not doing the things that add value to the business. Mm-hmm. They're running the business the way they think they need to be, but they're not thinking about adding value as they go along.
The kind of, I think what you're alluding to is like the McDonald's, the E-Myth, like the process, the manuals, the repeatable parts of the business that someone could come in and buy that business and keep operating it the same way. Is that what you're kind of alluding to?
Yeah. One way that we like to, so a third of our clients, or maybe even more than that, are ESOPs. So they do have a valuation done every year.
Because it's required.
It is required.
Yeah.
And if if an employee leaves during the year, they get bought out at the price that we value it at the beginning of the year. And so, as we go in like year 2, year 3, they start to see the trend of the value. And we start talking about, why is the value going up? What are the things that you're doing that are adding value? Mm-hmm. If we value it at 5 times EBITDA for every dollar of EBITDA you add to the bottom line, you're adding $5 of value.
I like that number. Keep talking.
Keep saying your words, Flo. Keep saying your words.
And so, once you get the management team, and then the management team starts talking to the employees about that, you start to find that the employees start thinking about adding value in everything that they do.
Yeah.
Why are we printing all of this paper? That's an expense that's decreasing value to the company.
Nice.
And so once you start thinking that way, expense, how does that affect value? Income, how does that affect value?
On that vein, I feel like if you're going to a realtor, what's your best bang for your buck? Kitchen. Or, like master bedroom, whatever, master bathroom. What is the best bang for your buck for evaluation for your business that normal people start with, or that you see in your business?
Yeah. A lot of times there's overhead. They don't think about, they have maybe they're overstaffed or they're not a lot of our clients, right, I would say, I have seen some of our clients that don't track their inventory, cost of goods sold.
We talk about that all the time. I want to come back to that. Keep going.
Yeah. And so if you don't know what you're paying for each part and the volatility year to year or even month to month, how can you price that product on the back end and make sure that you're still making a profit on it?
Right.
So there's a lot of slippage there. And I'd say that's a good place to start if you're not keeping track of that.
So one of the things, I did just shy, I think it was like a month shy or 2 months shy of 5 years at Deloitte & Touche. And we kind of talked about this before the show. But we have a lot of business owner clients who are in they're reselling stuff basically, right?
Yeah.
They do have cost of goods sold. They do have inventory. And the thing that we invariably come back to is, kind of like the E-Myth, how much does the sugar cost in the pie? If you haven't read the E-Myth in your business owner, you just have to read it. But how much does the pie cost, the crust, the sugar, the flour, whatever. And I think small business owners, they get in like, I'm going to sell this thing, and they don't appreciate the cost of goods sold. They don't appreciate how to set up their P&L to understand their numbers, track their numbers. And, what I kind of tell them is the unfortunate thing is, like, especially if you're doing less than I would say a couple $1 million of revenue, you have the requirement almost of like a $10 million accounting system, but you're not doing 10 million in revenue. Like, if you really want to track the numbers, you have to operate like you're making $10 million. Otherwise, you probably won't get there, because the death of 1,000 cuts is going to just kill you if you don't know how much this stuff costs and what your truly profit is. So I appreciate you saying that. I'd love to see how you get it on the back end of like, oh no, this is just how we do it. But someone coming in and buying that business, it's like, wait a minute, what am I buying? How much am I going to make?
Yeah.
Well, and the valuable part, I'll say where Brian and I are, is like we get a chance to change moving forward, where you are kind of like, okay, we're at the 3-yard line. Yeah. Like, it would have been nice if we would have thought about this in the 40, coming in.
We try to get clients early and earlier to start thinking about it. And, by the time they get to us, you're right. You're typically too late, but we rely on accountants, CPA, CPA.
Okay, back to this, and I don't want to bang this drum, but like, it is emotional, and this is a way to make it unemotionable. Like, start focusing on the numbers, start doing your cost of goods sold, your inventory. I mean, I love it. Brian's really gifted at this. So we did this with the client, and now like he has a different energy towards his business because he's looking at the numbers in a different way of like,
basically he was ready to sell. Like, I'm not making any money.
Yeah.
Right.
And
he wasn't.
He kept drilling down in the numbers, raise prices again. Got it all. Now, boom, monthly income, net profit every month now, like clockwork.
Dude, it was 2 weeks ago. I saw him at a wedding, and he was like, yeah, I'm going to try to get this thing up to 500,000. I'm walking away from it. And then this week, we had a conference call with him, and he's like, yeah, I'm not going to do that. Like, there's no way I'm letting this thing go.
I'm making money now.
So,
yeah,
that's encouraging. Sorry. Just take it over.
That's
I want to go back to the ESOP, because I think there's a life cycle as a business owner. I wouldn't say we're there yet. I think we're getting closer to it, where, you have a closely held business and we're young and we're growing and it's good. We have a great team. And it's like, how do you keep that going? How do you maybe start to cash out a little bit, but you still want to benefit from the business? We're not done yet, but you want your team members to profit. So maybe kind of walk through, like, when you start advising a company to look at an ESOP. I think ESOP's pretty popular. as a way to go, and then kind of like let's kind of navigate some of these maybe subsets of ways to cash out but still run the business.
Yeah, absolutely. So ESOPs typically are good for businesses. The motivation people use to set up an ESOP, they want to incentivize their employees. They want to keep the business local. If you sell into a private equity group, they might shut down a plant in a small town, and then the small town disappears.
Right.
Or they need to escape, and there's no buyers essentially.
Right.
And so,
real quick, can you just define what ESOP means, just so our listeners are on the same page?
For the Phillips in the world. Yep.
So it's an employee stock ownership plan.
Got it.
And so there's a trust set up that owns the shares of the company. And every year or month, the company makes contributions to the trust, and the trust releases shares to the employees. And so essentially, it's like a 401k that is invested in the company. And so when you retire, you have X number of shares. We have a valuation done that year, value times price, and that's what you get paid out at. So it's a great way to incentivize employees to stay with the business.
And those people get it at retirement. They can't just like pay out or buy out of it. Like, hey, I'm 38. It's a great price. Let me buy out of that thing.
Yeah. So incorrect. If you leave, if you're fired, if you quit, if you go to another job, you get paid out the number of shares that you have.
Okay.
But a lot of these are set up where they can wait 5 years, cash you out, and then pay you out over another 5 years, which disincentivizes people to leave.
Right.
Whereas if you had $100,000 of shares set up, you leave the company, start up a competitor, and they paid you out right away. Then you have the capital.
So I think I wanted two things. One, I think one of the best ESOP companies I think everybody would know, at least in the Midwest, is Hy-Vee, right? Like aren't they a true ESOP?
They're a true ESOP,
okay,
but they are employee owned.
Yeah.
So there's a little bit of a different.
They're a little bit of a hybrid, but kind of the same.
ITA Group, my first company that I came from, was an ESOP.
Okay.
And every time they announced the ESOP number, like people were bawling and I was like, they won the lottery. Yeah. So, I mean, I get it. It's powerful.
What are just the high level top 2, 3, requirements, barriers to entry to start the ESOP? Just keep it super simple.
Yeah. So you need at least 20 employees, and that's kind of a technical thing with, you can't have one employee making over a certain percentage of salary. So you have to have at least 20 employees. You have to have a good management team that can run the business once the owner retires and leaves the business. And you have to have a decent enough value that it makes sense to pay the annual administrative fees. You have to have a valuation done every year. Mm-hmm. Typically, you have an external trustee. So there are expenses associated with it.
What does that look like a year? Just like ballpark, just so
all in, maybe $20,000 a year, $20,000 or $30,000. It depends on the size and who you're using and stuff like that. So.
Gotcha. And then how much of the stock does the ownership team or person have to sell to start the ESOP?
Yeah, so you're paying fees for a transaction, so it makes sense that you're going to do a big enough chunk. Typically, it's 20 or 33%. Would be the smallest that we would see. There are ways to do it, kind of a backdoor approach where you don't have to do a transaction. You contribute shares of the company to the ESOP, and it gets a little bit more complicated.
Sure.
But a lot of the transactions that we're doing, they're going 100% ESOP right off the bat. So one benefit of 100% ESOP, if you're an S corporation, the tax liability of the corporation gets passed on to the trust. The trust is a non-taxed entity. So essentially, the company doesn't pay taxes.
Wow.
And so they're able to accumulate a bunch of cash, make acquisitions, and it works out pretty well.
Yeah.
That's actually really cool.
Well, I think too, because you see publicly traded companies, I think Facebook is probably one of the best, just because everyone kind of watched that happen. But, waited a long time to go public. There's a lot of private equity money in there. Then finally went public. Made a lot of people a lot of money. But as business owners or small business owners of privately held businesses, it's like, okay, we're probably not going to go public. But what other options do we have? So could you just talk kind of high level about growing? We've had several business owners lately just I need more capital. Do I go hard money loans? Kind of, you know what I mean? We're kind of in this weird
no
space
man's land
where it's we're probably not going to go private equity or something like that. But we want to grow. We want to have capital. We want our team to do well. Can you kind of lay out that optionality?
Yeah, we don't get involved with that, but
That's not us.
but I mean, I have seen businesses, sell 15% to like a merchant bank or something, or private investors.
Sure.
Sometimes the business owner, if they want to liquidate a portion of their business, they will have some of the management team buy in, and then that also starts the transition of transferring to that next level of management if they want to become the owners. So there are options like that, but like I said, that's not something we get into as much.
Sure.
So I can't be an expert.
Go talk to principal on that one. I'm just kidding. Okay, so give me a ballpark of like the dumbed down valuation. How much does it cost to work with BBC Advisors? And then how much does it cost for like the full blown evaluation? You're at the end of your career, business, whatever.
Yeah, so we offer essentially 3 tiers of valuation depending on the purpose. So if you're an operating business and you're doing estate and gift work, and our report is going to get sent to the IRS, you need a full appraisal report.
Yes.
And so, a report like that, typically $10,000 to $12,000 for an operating business, and that's kind of just baseline, run of the mill.
Yep.
Not a lot of complexity in your business.
Right.
That's like the Toyota Corolla, or like the
That's like exactly. That's a good way to put it. Yeah.
Whoa.
Okay.
Whoa. He likes it. He likes it.
So if you are, 2 business owners and you're trying to do a buy-sell agreement and you can't agree on the price, or you're trying to buy out one of the owners and you just need a letter report, that's kind of our middle tier. It might be $8,000 to $10,000. If you just kind of want to know what a baseline value of my business is, we do calculations, and that varies kind of depending on what you want out of it. And if you want consulting on the back end to help you kind of understand it, it can be anywhere from 4 to 8, probably 8,000.
Nice. Okay. And you do work with financial advisors. That was a question I didn't ask the principal. Dang it.
Yeah, there isn't an industry that we haven't done, or I guess.
What's the most quirky industry you've had to evaluate?
Yeah, for a while there, we were doing a lot of ethanol plants, which is kind of an interesting thing.
Yeah.
I did a lot of ethanol work when I was at Deloitte. That was when they were trying to go public and, organize, and there's a lot of free money out there and cheap money, we'll say, but maybe put it that way. But yeah.
Yeah, and that's a tough industry because there's so much commodity based movement that essentially you're trying. Do they have a mechanism to lock in their margins? Month to month.
Right.
Gotcha.
Okay, so when you don't want them on the 3-yard line. So when would you want them, obviously, to come in and then give our listeners a little bit of idea of like, hey, if this is you, come talk to us, kind of thing.
If you're planning to retire in the next 5 years, I think that's a good time to start thinking about what is your plan. And we can help you be a part of that plan. You guys probably do more of the help once they understand the value of their business. But if you, like you said, if you come to us when it's time to, there's not much we can do to help you understand how to increase the value of your business, how to get it set up in a way that if you want to have an external buyer, what are they looking for? Do you have clean financials?
Real financials,
yes. I can't tell you the number of businesses that come to us with internal financials out of QuickBook, and I'm like, if you go to a buyer with this, they're not gonna trust the numbers,
right?
So if I'm gonna buy a business, generally I'm looking for 3 to 5 years of historical financials, and so if you can build on a 5-year period to really peak at the right point, that's going to set you up for a good sale exit. If you're looking for an ESOP transaction, the whole process probably takes 9 months. If you think your business is ready, financially, you've set it up to in a good point, we can get a transaction done in about a 9-month period. Anything shorter than that, and you're probably going to be pushing it a little too much.
Sure.
I'm trying to think other scenarios. If you want a buy-sell agreement, maybe you're an early stage business, you just started, you have 2 owners that don't necessarily. Let's see. Let me start. Buy-sell agreement. You have 2 owners, and you're just starting a business together. Make sure you have a buy-sell agreement in place, because you don't know what's going to happen 5 years down the line, and you want to make sure that you both have an understanding of how you're going to be bought out if one of you has to exit. Mm-hmm. We can set up either a formula, or we can do a valuation and then just have the buy-sell agreement say that you have to have a valuation done, and these are the parameters.
Prior to,
Yeah.
If you're an early stage business, 5 years from now, your business is probably going to look a lot different. So if you do have a formula in place, you want to make sure that you revisit that buy-sell agreement periodically to make sure it still makes sense for how your business is.
Sure.
Now, does BCC Advisors, BCC Advisors, do they help people like acquire businesses and sell businesses? Like, do you do all that?
Yeah, we do. I'm on the business valuation side, but we have 3 partners that do M&A work.
Interesting.
They help middle market businesses go through the full process. So if they're getting ready to sell, they'll go out, identify buyers, get them approved by the seller to make sure that there's no hard feelings between the buyer and seller. It's going to be a good fit. They'll contact them. They'll try to get multiple buyers lined up, offer bids. So it's an auction process to try to drive up the price. And then they help all the way through closing, due diligence, everything like that.
Huh. Very cool.
What would you say is on the back end to like a business owner that's selling of like we had a situation where a guy wanted to sell his business and it was like, I would say 90% seller financed. And I was just like, dude, you're taking so much risk on this deal. And he was going to seller finance the building that the business was in, which is a separate asset, and seller finance the business. And I'm like,
don't do this.
And then he was going to work there for like 2 or 3 years. And I'm like, this is a recipe for disaster.
That's a lot of eggs in that basket.
Right. So, we ended up saying, hey, keep the building, give the guy a first right of refusal, but make him sign a 5-year lease, keep that asset to your benefit.
Yep.
And then sell the business at market value and seller finance maybe 10, 20, 30% of it. Something like that. And they ended up closing the deal pretty close to that.
Yeah.
So kind of walk through maybe like what not to do if you're the business owner, like, well, I'm going to work for this guy for 5 years. Like, no, you're not. That's not going to go well.
Yeah.
Maybe if it's your son, but
even that, I wouldn't do it.
Yeah. It's pretty typical to have a 1 to 3 year, where they stay on to kind of transition the business. 5-year gets to be a lot.
Yeah.
If you're doing a 90% seller finance, you're getting none of the upside and you're taking all of the risk. So that doesn't make any sense.
Right.
So the structure that you said makes total sense. A lot of times we'll see an earnout involved so that the buyer has some protection that in case you don't, they don't trust your numbers. You think the value's here, they think it's lower. You can bridge that gap by an earnout, and then if the business proves it, you're still working in the business, so you can make sure that they're not just tanking it so they don't have to pay you.
Right.
But that's a good way to do it. On ESOP deals, we've also seen a lot of clawbacks where if the business underperforms, they have the ability to claw back some of the purchase price.
That's good.
It's kind of an offset to the buy or the earnout. Typically it's both involved.
Sure.
Is it best practice to make sure they have like a first right of refusal if this thing goes south, like the owner can come back and buy it, or like?
I'm not sure if I've seen that. I don't work as much on the M&A side, but that doesn't sound like something I've seen.
Okay. It's good.
You hear those stories though of like,
but if you have owner financing, of course you're gonna get it back.
But you see those where I was just watching a video. This guy sold his company to like AOL for like $800 million, and he ended up buying it back for like $25 million. 6 years later, and they ran into the ground.
Yeah.
But I definitely think that's probably more the anomaly than the standard. But
probably.
I just love business. I love talking business. I mean, you see a lot of different business. Like, what gets you excited about business? And obviously there's a lot of geopolitical, economic stuff going on, but people need stuff. People want to do good business. People need products. Like, what are you excited about as you look kind of forward?
Yeah, I love helping the small business owner that is getting close to retirement and they don't have a plan yet. And so I can help them understand the value of the business, kind of give them advice on things that they can do that gets them comfortable, that they can, feel safe to sell the business, and they'll be financially set going forward. I love the ESOPs that I work with. A lot of them are set up for the right reasons. You get to see the benefit to both the employee and the seller. It does seem like a win-win in a lot of those situations. So those are the kind of things I like to see the happy ending at the end of the process.
Sure.
How do our listeners get to know more about BCC, how do they contact you, all that?
Yeah.
So our website is bccadvisors.com.
Well done on that, by the way.
I
feel like a lot of businesses don't do that URL thing right. It's like, no, it's bccadvisors.com.
Yeah.
Great
we
job.
do have one small quirk where advisors is spelled with an E. It's a long story. You know, a website wasn't available back when it was
Probably
formed.
Philip was the one who spelled it. I don't know.
But I think we do have it now, where either one will get you to the correct
Wow.
website.
Nice.
So.
Well, thank you for being on. Thanks for your expertise. And I know that it is super valuable to have somebody come in as a business owner and evaluate something they've been working so hard on. So appreciate all your hard work. Appreciate your insight and wisdom. You've been listening to the Uncommon Wealth Podcast. I've been your host, Philip Ramsey.
And I'm Brian Dewhurst.
Until next time, go be uncommon. Thanks for listening.
Thanks, everybody.
That's all for this episode, brought to you by Uncommon Wealth Partners. Be sure to visit uncommonwealth.com to learn more about our services. Don't miss an episode as we introduce you to inspiring people who are actively pursuing an uncommon life.